Hi everybody, Tom Morrison here, Aria Financial, back with another episode of Real Talk with Tom, where we review client case studies. And this week's particular episode, we'll talk about a client who they're both PAYG. There's some bonus income involved, there's a gift involved, maternity leave involved, and a bank that doesn't guarantee the pre-approval loan amount. Okay, so why don't we start with the maternity leave aspect of the scenario. In this case, obviously, it was the female applicant. There's also paternity leave available for male applicants as well. In this case, it was the female applicant with maternity leave. And there's different types of policies that come into play here. Usually when you're on maternity leave, you'll receive perhaps some initial payments from your employer and then perhaps some payments from the government. Sometimes there's a period of time where no income is being received at all for the applicant. And obviously, the applicants almost always are planning to go back to work. Sometimes they're not, and that's okay. In this case, the female applicant was planning to go back to work, in 9 months' time. And when that's the case, and obviously she's going to be earning income, at that period of time in the future, we can simply get a letter from the client's employer, and it confirms the return to work date, the return to work income, position, sort of basically almost like an employment letter for the details surrounding the employment at the time the female applicant in this case goes back to work. And what the bank will do is they'll actually work out what the shortfall is, i.e. what the income that she's not receiving is before she goes back to work. And providing we can evidence that that client will be able to either raise the funds or has the funds available or maybe has liquid assets in shares to cover that shortfall in that 9 month span, the bank will use her income as what it would be if she was back at work 9 months in the future. So that was one particular area we had to navigate. Some banks want you to go back within 3 months. Some banks want you to go back within 1 month. Some banks want you to go back within 6 months. Some banks don't like it at all. So there's definitely variations of how that policy is interpreted. Both applicants have received a bonus over the last 2 years, and the latest year was higher for both of them. And we need to maximize borrowing capacity. And most banks, when it comes to bonus income, will either take the lower of the last 2 years, they'll average the last 2 years, they'll take the lower year plus 20%, or in limited cases, they'll take the latest year. And we needed the latest year as well, okay, in this situation to maximize borrowing capacity. There was also a gift involved. Gifts are pretty standard. Obviously, they're provided from a family member in most cases. And all that we need to provide to the bank to evidence those funds is a letter from the person making the gift that it's a non-refundable gift. In some cases, families, for family court reasons or asset protection reasons, will make a loan to the applicants instead of a gift, and the loan will be a non-repayable loan with no interest charged on the loan and no payments made during the course of the loan, and the loan is only repayable at the time the property is sold in the future, if it's sold in the future. Banks struggle to interpret those types of loans, even though they really don't impact the cash flow of the applicant at all. Some banks will actually amortize that loan, which effectively building it as a liability in the application, which can lower borrowing capacity. So in this case, that's not this case, but that's a variation of what a gift can also be. And then we had to be approved with a bank for all of the above reasons. And that particular bank was best on price, but didn't guarantee the pre-approval amount. And what that means is that we got approved for the maximum borrowing capacity. And if rates increased by, say, 0.25%, the borrowing capacity would almost be void and it would be lower immediately as a result. And so what these clients did is they went out and got a buyer's agent to expedite the search process so that they could enact that pre-approval as quickly as possible to prevent themselves from incurring any drop in borrowing capacity as a result of any future rate rises. That's this week's case study. Look forward to speaking to you all soon. Thank you very much.